Alright, real quick before we get started, this isn't financial advice, okay? It's all for educational purpose only. Always do your own research before taking any trades. Cool? Alright, let's dive right in. So today we're diving into one of my favorite setups, the best moving average strategy for support and resistance breakouts. Now, this one's pure price action. We're not relying on fancy indicators or signals. We're just using moving average lines as a visual guide, especially for beginner traders who want a little extra confirmation on the chart. So here's the plan. We need 3 moving averages on the chart, but since TradingView doesn't actually let us stack 3 separate MA indicators easily, we're gonna use one indicator that can handle multiple lines, the moving average ribbon. Now, if you've never used it before, no worries. Once you added it, you'll see it comes with 4 moving averages by default: MA20, MA50, MA100, and MA200. But here's the thing, those default settings aren't the best for this method, so we're gonna make a few quick adjustments to really fine tune it. Alright, step by step, open the indicator settings. Step 1. Disable the first line. That's MA number 1, the 20 MA. It's way too close to the price candles and doesn't really help us identify a structure or trend here, so we don't need it. Step 2. For MA2, switch the type from SMA to EMA and set the period to 45. Then pick a color that's super visible, maybe yellow or something bright, so it stands out clearly on your chart. And step 3. For MA3, keep it as an EMA2, but leave the period to 100. Again, change the color to something easy to spot, like blue or whatever you like. Then step 4. And finally, for MA4, change the type to SMA. Set the period to 300 and pick a color that really contrasts. White works great for the longer term line. Now, one more quick thing. Go to the Style tab and make each line a little thicker. It just helps a lot when you're analyzing the chart, so you can easily tell which MA is which without zooming in too much. So you've got these set up: yellow line EMA 45, blue line EMA 100, and white line SMA 300. Alright, so now the fun part. How do we actually use these 3 lines? Hit the like button real quick and let's break it down step by step. The SMA 300 is our main guide for identifying the major trend of the market. When price candles are above the SMA 300, we call that an uptrend. And when price candles are below it, that's a downtrend. Simple, right? But now, what about the EMA 45 or EMA 100? These two are like short-term and mid-term trend guides. They help you understand the minor trend direction inside the bigger trend. Basically, they tell you how price is behaving within that main move. So let's piece it all together with a real chart example. Right here, we've got gold XAU-USD on the 4-hour time frame. Here's how the rules go one by one. Rule 1. If the price candles are above all three lines, the EMA 45, EMA 100, and SMA 300, that means the market is strongly trending up. And rule number 2, at the same point, the price might cross below the EMA 45 or even the EMA 100. That's totally fine. It doesn't mean the trend is reversing just yet. And rule number 3, here's the key part. Even if the price dips below the EMAs, as long as it stays above the SMA 300, the major trend is still considered up. This rule keeps you on the right side of the trend. And rule number 4. Next, you want to identify the most recent swing high zone. That's basically your resistance area in price action terms. And rule number 5, now the final step. Once price breaks above the recent swing high zone, that breakout confirms momentum continuation in an uptrend, and that becomes your buy signal. So in this setup, we're only looking for buys when the market is in an uptrend, meaning price stays above the SMA 300. And for your stop loss, you've got two good options. You can place it right below the most recent swing low, or you can use one of the EMAs as a dynamic stop loss area. So your take profit goes at least a 1-to-2 risk to reward ratio, or if you like to manage trades actively, you can trail your stop loss along one of the EMAs as price moves in your favor. Alright, now check this out. A few candles later, on the same gold chart, price steps back below the EMAs again, but it still stays above the SMA 300. That's fine, the main trend is still up. Then we mark the new swing high zone again. That's your resistance area. Once price breaks above that zone, that's another buy opportunity, nice and clean. Now let's flip things around for a sell example. Here's we're looking at Ethereum ETH on the 1-minute time frame. Price is below the SMA 300, so this time we're clearly in a downtrend. Then price pull back and move above the EMA 45 and EMA 100 temporarily. That's normal trends brief, right? But now we identify the most recent swing low zone. That's our support area. So here's what we do. We wait for the price to break below the recent swing low zone. When it does, that's your sell signal. Same concept. You're just trading in the opposite direction. And that's it. That's the whole system. Simple, visual, and completely based on price action confirmation using moving averages has a structured support. If you're digging this kind of clean, real-based setup and you want to see an even simpler buy-sell indicator strategy on TradingView, make sure to watch the recommended video right here on the screen. It's the perfect next step to build on what we just learned. Happy trading!